Have you ever felt like you need a finance degree to understand investing? I've been there too. Join me as I take on the challenge of mastering the stock market in just 10 minutes by breaking down 40 key stock market terms. By the end of this video, you will be speaking like a Wall Street pro. Is there a term I missed? Drop it in the comments. I would love to hear from you. Bastu. Wait, this was not the final of the Eurovision Song Contest. Okay, let's start. After this video, you should at least remember stock market terms number 36 and number 40. Stock exchange. A marketplace where investors can buy or sell stocks. Stock represents ownership in a company. If you own 50% of Tesla stock, you own half of Tesla. Please don't tell to Elon Musk, but that's actually more than what he owns. Shareholder owns stocks in a company. Public company. There are public and private companies. Public company is a business whose shares are traded on the stock exchange. For example, McDonald's. Private company shares cannot be purchased on the stock exchange. For example, IKEA. I guess you know the IKEA meatball. Market cap. The last share price multiplied by total number of shares outstanding. For example, if the share price is 10 and there are a total of 10 shares, the company's market cap is 100. Actually, Apple has the highest market cap in the world with nearly $3.4 billion. IPO. IPO, or initial public offering, is when a company offers its shares to the public for the first time, allowing investors to buy ownership in the company. The company, for example, might need money for growing its business, or maybe there are some investors who would like to sell some of their shares. Can you remember Rivian, an electric vehicle automaker, who IPO'd in 2021? It was nearly a $14 billion IPO. Crazy. You lost actually nearly everything. Bastu. Oh wait, this was still not the final of the Eurovision Song Contest. Sorry. But if you liked the video, please remember to hit the like button. Thanks. Dividends. A portion of a company's earnings that is paid to investors who own the stock. Every company doesn't pay dividends. For example, Coca-Cola pays a dividend, Amazon doesn't. Bull and bear market. Bull market means that prices are rising, and the bear market means that the prices are falling. Someone is said to be bullish or bearish if they believe the value of a stock or market will rise or decline. Bubble occurs when the prices of stocks rise far beyond their value, driven by excessive speculation. For example, if you remember, in the late 1990s, after the dot-com bubble burst, Amazon stock lost more than 90%. Well, after that crash, the stock price gone up quite a lot, as you can see in the graphs. Volatility indicates how much and how quickly the value of a stock changes. Volume. Number of shares of a company traded each day. Liquidity. How easily a stock can be bought or sold without affecting its price. Large companies, they tend to have great liquidity, whereas small companies have low liquidity. Very large investors, they can typically invest in small companies because of low liquidity. Ticker is a unique symbol used to identify a specific stock. It's typically a short combination of letters. For example, AAPL for Apple. 1, 2, 3, sauna. Oh, please stop it now. No Eurovision. I just want to talk about a broker next. Broker. Unfortunately, you can't go directly to the stock exchange to buy or sell stocks. That's why you have brokers. They act as intermediaries between the buyer and the seller, executing trades for commission or fee. Some well-known brokers include companies such as Charles Schwab, or Interactive Brokers, or Nordnet in the Nordic countries, where I live. Bid. Once you log into your broker account, bid is the highest price a buyer is willing to pay. My example is from Nordnet, the Nordic broker, but you learn some Finnish too. Osto is the bid price. Ask. The lowest price a seller is willing to sell. Same example. Myynti is the ask price. Bid-ask spread. Difference between the ask and the bid price. If the bid is, for example, $100 and the ask price is $101, the spread is $1. Generally, the smaller the spread in percentage, the higher the liquidity. Going long. Buying a stock with the expectation that its price will rise over time. Well, maybe some will buy a stock as they want to get access to annual meetings to get a free coffee. Not that I would have done it. Shorting. Short selling is a strategy used by those who think the price of a stock is going to decrease in the short term. You borrow a stock from your broker to sell on the market. You never own the stock. It's a high-risk investment strategy. Short squeeze. Happens when a heavily shorted stock suddenly rises in value. Remember the short squeeze in GameStop in 2021. Many large institutions lost crazy amount of money as they had shorted the stock. Index. Tracks the performance of a group of stocks like the S&P 500, which tracks the top 500 companies by market cap in the US. Index fund. A fund with the objective to match the investment performance of an index. As you can directly buy an index like the S&P 500, you can buy an index fund that tracks the index. Well, you could buy all 500 companies individually, but for every transaction you pay a fee. It would become quite expensive. ETFs. It's like an index fund. The main difference is that ETFs can be traded throughout the day like stocks. ETFs tend to have low fees, that's why they are more and more popular. Besides stocks, I invest in ETFs. Hedge fund. A fund that seeks to generate investment returns by typically using non-traditional investment strategies, usually used by wealthy individuals and institutions. Mutual fund. A public investment vehicle that pulls money from many investors to invest in a diversified portfolio of stocks, bonds, or other securities. It's designed more for individual investors than hedge funds. Fees are higher than for index funds or ETFs, but typically lower than for hedge funds. Income statement. Summary of a company's revenue and expenses over a specific period, which shows whether the company has made a profit or a loss. I have used Ferrari's income statement as an example. Balance sheet. A summary of a company's assets, liabilities, and owner's equity. A balance sheet basically shows a company's financial condition at a given time. Cash flow statement. A summary of the amount of cash generated and used by a company during a specific time period. My plan is actually to make a separate video where I go through all the three statements, so the income statement, the balance sheet, and the cash flow statement, and how they are connected. A video that you have not seen before, so make sure to subscribe and get notified. Earnings per share. A company's profit divided by its total number of shares outstanding. So, for example, if the company made a profit of 100 and has a total number of shares 100, its earnings per share equals to 1. PE ratio. It's actually one of the most widely used tools that investors use to determine a stock's valuation. If the share price is 10 and the earnings per share is 1, the PE ratio or the PE multiple equals to 10. One tip: never ever invest in a company only because of its low PE ratio. Trailing PE. Calculated by dividing the current stock price by the earnings per share over the past 12 months. Forward PE. Calculated by dividing the current stock price by the expected earnings per share over the coming 12 months. Enterprise value is a measure of a company's total value, including its market cap, debt, and cash. For example, Ferrari has a market cap of 71.9 billion euros. It has 3.4 billion in debt and 1.7 billion in cash. Thus, its enterprise value is 73.6 billion euros. This is what the investors think the company is worth. If you buy the company, you get the debt and cash as well. EV, EBIT. Besides the PE ratio, another financial ratio used to evaluate a company's valuation. It compares the enterprise value to its earnings before interest and taxes. That's why EBIT. In short, EV/EBIT is more comprehensive as it factors in debt, while PE is simpler and focused solely on equity earnings. Free cash flow yield. It's actually my favorite valuation metric. It's a financial metric that compares a company's free cash flow, so the cash generated after expenses and investments, to its market value. Cash is always king, and cash can't be manipulated the same way as earnings can be manipulated in the income statement. Compounding. As Albert Einstein once said, compound interest is the eighth wonder of the world. Compounding refers to the process where the returns on your investment earn returns themselves over time. So in simple terms, it's earning interest on interest. Let's say that you invest $100, you earn 10% annual return. After year 1, you have $100 plus 10% of $100. So that's $110. Then after year 2, you have $110 plus 10% of $110. That's $121. Or how about this example? You invest $1,000 for your kid, earn 8% annually, and in 70 years the investment has become $219,000. The beauty of compounding. Intrinsic value. What an asset is worth is usually different from the current market price. Value investing. An investment strategy where investors purchase stocks that they believe are selling below estimated true value. Growth investing. An investment strategy that focuses on stocks where earnings are growing rapidly and they are expected to continue growing. As you can see in the graph, over the past 50-year period, growth investing has actually outperformed value investing. Diversification. A risk-reducing investment strategy that combines different stocks or even different assets, stocks, bonds, cash, you name it, that are unlikely to move price-wise in the same direction at the same time. In other words, don't put all your eggs in one basket. Yeah, I know, some investors might have earned thousands of percents if they invested in Netflix, for example, at the right time, but some lost 83%. If you remember something from this video, remember this. Don't ever put all your money in one stock. Please leave a comment if I missed any important stock market term. And check this video about investing in Ferrari. Did you know that Ferrari will reveal its first ever electric vehicle in October? Anyway, thank you for watching.